Hi, I'm Rose. Welcome to Smart College Online. Today's course is about accounting and finance. Overview of the field. Accounting and finance are interrelated fields that are essential for the proper functioning of any business or organization. Accounting is the process of recording, classifying, and summarizing financial transactions to provide information that is useful in making business decisions. The information generated by accounting is used to prepare financial statements, which are used to communicate the financial health of the organization to stakeholders. Finance, on the other hand, deals with the management of an organization's financial resources. This includes the assessment of financial risks and opportunities, the management of investments, and the planning and execution of financial strategies. In addition to providing financial information, finance also plays a critical role in decision-making by helping organizations to identify and evaluate different investment and financing options. Together, accounting and finance provide a comprehensive understanding of an organization's financial situation, which is essential for effective decision-making and strategic planning. B. Importance of accounting and finance in business. The importance of accounting and finance in business cannot be overstated. In order for a business to be successful, it must have a clear understanding of its financial situation and be able to make informed decisions based on that information. Accounting is the foundation of this process, as it provides the information that is used to prepare financial statements and other financial reports. These financial statements are used to communicate the financial health of the organization to stakeholders, including investors, creditors, and management. Without accurate and timely financial information, it would be impossible to make informed decisions about the allocation of resources, expansion plans, or other important business decisions. Finance is also critical to the success of a business, as it helps organizations to assess financial risks and opportunities, and make informed decisions about investments and financing. This includes evaluating different investment options, such as stocks, bonds, and real estate, and determining the best financing options, such as equity or debt financing. By effectively managing financial resources, businesses can maximize returns and minimize risks, which is essential for long-term success. In addition to its role in decision-making, accounting and finance also play a critical role in compliance. Governments and other regulatory bodies have established a wide range of laws and regulations related to financial reporting and accounting, and businesses must comply with these regulations to avoid penalties and legal action. This includes the preparation of financial statements in accordance with generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS, and the filing of tax returns and other required financial statements with the relevant authorities. Introduction to Accounting and Finance. A. Overview of the field. Accounting and finance are interrelated fields that are essential for the proper functioning of any business or organization. Accounting is the process of recording, classifying, and summarizing financial transactions to provide information that is useful in making business decisions. The information generated by accounting is used to prepare financial statements, which are used to communicate the financial health of the organization to stakeholders. Finance, on the other hand, deals with the management of an organization's financial resources. This includes the assessment of financial risks and opportunities, the management of investments, and the planning and execution of financial strategies. In addition to providing financial information, finance also plays a critical role in decision-making by helping organizations to identify and evaluate different investment and financing options. Together, accounting and finance provide a comprehensive understanding of an organization's financial situation, which is essential for effective decision-making and strategic planning. B. Importance of accounting and finance in business. Accounting and finance are essential functions of any business, as they play a critical role in the management and operation of the company. Accounting is the process of recording, classifying, and summarizing financial transactions, while finance is the process of managing the company's financial resources. Together, they provide the information and tools necessary for effective decision-making and management. Accounting is important in business because it provides the financial information needed to make informed decisions. Financial statements, such as the income statement and balance sheet, provide an overview of a company's financial performance and position. This information is used by managers, investors, and other stakeholders to evaluate the company's performance and make decisions about future investments and operations. Finance is important in business because it plays a critical role in the management and allocation of financial resources. Financial managers use financial analysis and planning to make decisions about investments, financing, and risk management. They also use financial models and forecasting to predict future financial performance and identify potential risks. In addition, finance also plays an important role in the capital markets by helping companies raise capital through equity and debt financing. It also helps to manage the company's liquidity and risk by assessing the company's cash flow needs and making sure that the company has enough cash to meet its obligations. In conclusion, accounting and finance are essential functions of any business, as they provide the information and tools necessary for effective decision-making and management. They help companies to evaluate their financial performance, make informed decisions, and allocate resources effectively. Without the proper financial management, businesses may struggle to survive or thrive in a competitive market. A. Recording and reporting financial transactions. Financial accounting involves recording and reporting financial transactions by identifying, measuring, and recording them in a way that follows generally accepted accounting principles, GAAP. Transactions are recorded in a general ledger, which is organized into accounts for classification and summarization. The process begins with identifying the transaction, determining its value, and recording it in the general ledger by debiting or crediting the appropriate accounts. B. Preparation of financial statements. Preparation of financial statements is the next step after recording and reporting financial transactions. Financial statements summarize a company's financial performance and position. The three main statements are the balance sheet, income statement, and cash flow statement. The balance sheet shows assets, liabilities, and equity. The income statement shows revenue, expenses, and net income, and the cash flow statement shows cash generated from operating, investing, and financing activities. C. Analysis and interpretation of financial statements. The analysis and interpretation of financial statements is the process of evaluating a company's financial performance and position by examining its financial statements, such as the income statement, balance sheet, and cash flow statement. This process involves reviewing the company's financial data, identifying trends, and making comparisons to industry averages and previous periods. The income statement, also known as the profit and loss statement, shows a company's revenues, expenses, and net income over a specific period of time. By analyzing the income statement, analysts can evaluate a company's profitability, identify trends in revenue and expenses, and compare the company's performance to industry averages and previous periods. The balance sheet, on the other hand, shows a company's assets, liabilities, and equity at a specific point in time. By analyzing the balance sheet, analysts can evaluate a company's liquidity, leverage, and solvency. They can also identify trends in assets and liabilities, and compare the company's position to industry averages and previous periods. The cash flow statement shows a company's cash inflows and outflows over a specific period of time. This statement is important to evaluate a company's liquidity and ability to meet its financial obligations. By analyzing the cash flow statement, analysts can identify trends in cash flow, evaluate a company's ability to generate cash, and compare the company's performance to industry averages and previous periods. Interpreting financial statements requires a thorough understanding of accounting principles, financial analysis techniques, and the company's industry and operating environment. It is important to consider not only the financial data, but also the company's business model, management, and industry trends. The analysis and interpretation of financial statements provides a valuable insight into a company's financial performance and position, and it helps to identify potential risks and opportunities for improvement. Managerial accounting. A. Cost accounting. Cost accounting is the process of identifying, measuring, analyzing, and communicating cost information to management. This information is used to make decisions about pricing, product development, and resource allocation. Cost accounting is an essential function for any business, as it enables managers to understand the costs associated with their products, services, and operations. Cost accounting involves several key activities such as cost measurement, cost behavior analysis, and cost volume profit analysis. Cost measurement is the process of assigning costs to products, services, and activities. Cost behavior analysis is the process of identifying how costs change as a result of changes in activity. Cost volume profit analysis is the process of identifying the relationship between costs, volume, and profit. Cost accounting information is used to make decisions about pricing, product development, and resource allocation. For example, cost accounting information can help managers understand the costs associated with a new product or service, and use this information to make decisions about pricing. Cost accounting information can also help managers understand the costs associated with different production methods, and use this information to make decisions about product development. B. Budgeting and forecasting. Budgeting and forecasting are essential tools for financial management and planning. Budgeting is the process of creating a financial plan for a specific period of time, typically a year. Forecasting is the process of predicting future financial performance. Budgeting and forecasting are essential for making informed decisions about financial resources, such as investments, financing, and risk management. Budgeting and forecasting involve several key activities, such as revenue forecasting, expense forecasting, and cash flow forecasting. Revenue forecasting is the process of predicting future revenue based on historical data and market trends. Expense forecasting is the process of predicting future expenses based on historical data and market trends. Cash flow forecasting is the process of predicting future cash flow based on historical data and market trends. Budgeting and forecasting are essential for making informed decisions about financial resources, such as investments, financing, and risk management. For example, budgeting and forecasting information can help managers identify potential cash flow issues and make decisions about financing. Budgeting and forecasting information can also help managers identify potential investments and make decisions about resource allocation. C. Performance evaluation and decision-making. Performance evaluation and decision-making are essential tools for business management. Performance evaluation is the process of measuring and assessing the performance of an organization or an individual. Decision-making is the process of choosing among different alternatives. Together, performance evaluation and decision-making are essential for making informed decisions about resource allocation, investments, financing, and risk management. Performance evaluation and decision-making involve several key activities such as performance measurement, performance analysis, and decision-making. Performance measurement is the process of measuring the performance of an organization or an individual. 4. Corporate finance. A. Time value of money, TVM, is a fundamental concept in corporate finance that relates to the idea that money has different values at different points in time. It states that a dollar received today is worth more than a dollar received in the future, because of the earning potential of that dollar. TVM is important in corporate finance because it is used to evaluate the profitability of potential investments, such as bonds or stocks. B. Capital budgeting is the process of evaluating potential investments and determining which ones to pursue. It involves analyzing the costs, risks, and potential returns of different investment opportunities and determining which projects will provide the highest return on investment. Capital budgeting is critical for companies because it helps them to make informed decisions about how to allocate their resources in order to achieve long-term growth and profitability. C. The cost of capital is the minimum return that an organization must earn on its investments in order to meet the expectations of its investors. It is used to evaluate the profitability of potential investments and is a key consideration in decision-making. The cost of capital can vary depending on the type of investment, the level of risk, and the company's overall financial situation. D. Financing decisions are critical for companies because they determine how a company will raise the funds necessary to invest in new projects and grow its business. Financing decisions include issuing bonds or stocks, borrowing money from banks, or using retained earnings. Each option has its own set of advantages and disadvantages, and companies must carefully evaluate their options in order to make the best decision for their business. In addition to these concepts, corporate finance also involves the management of a company's assets, liabilities, and equity, and how it can create value for its shareholders. It also involves the analysis of the company's cash flow and the management of its short-term and long-term financing needs. Corporate finance professionals use their knowledge of financial markets and investment strategies to make informed decisions and manage the financial resources of a company in order to achieve its goals. In order to make the right investment decision, a company should also evaluate the impact of taxes, inflation, and risk in the cash flows and returns of the project. The company should also consider the impact of the project on its overall capital structure, debt-equity ratio, and credit ratings. In conclusion, corporate finance is a critical aspect of accounting and finance, and it requires a thorough understanding of time value of money, capital budgeting, cost of capital, and financing decisions. These concepts are essential for evaluating the profitability of potential investments, making informed decisions about how to allocate resources, and managing the financial resources of a company to achieve its goals. V. Investments. A. Types of investments. There are many different types of investments that individuals and companies can make, each with its own unique set of risks and potential returns. Some of the most common types of investments include stocks, bonds, mutual funds, real estate, and commodities. Stocks are a type of investment that represents ownership in a company. When an individual or company purchases stocks, they become a shareholder in that company and have a claim on a portion of its profits and assets. Stocks can be highly volatile and risky, but they also have the potential for high returns. Bonds are a type of debt investment, where an investor lends money to a company or government in exchange for regular interest payments and the return of the original investment at maturity. Bonds tend to be less risky than stocks, but they also typically have lower potential returns. Mutual funds are a type of investment that pools the money of multiple investors and uses that money to buy a diverse portfolio of stocks, bonds, or other securities. Mutual funds can provide diversification and professional management, but they also typically have higher fees than other types of investments. Real estate is a tangible asset that can be used for investment purposes. Real estate investments can take many forms, such as buying a rental property, investing in a real estate investment trust, REIT, or participating in a real estate crowdfunding platform. Real estate investments can be relatively stable and generate steady cash flow, but they also require significant amounts of capital and can be affected by market conditions. Commodities are physical goods such as gold, oil, and agricultural products that are traded on global markets. Commodities can provide diversification and a hedge against inflation, but they also tend to be highly volatile and can be affected by weather, geopolitical events, and other factors. B. Portfolio management. Portfolio management is the process of selecting, monitoring, and adjusting a mix of investments in order to achieve a specific investment objective. A well-diversified portfolio can help to mitigate risk and maximize returns. There are many different portfolio management strategies that can be used, such as passive investing, active investing, and quantitative investing. Passive investing involves simply buying and holding a diversified set of investments, such as a low-cost index fund. Active investing involves actively buying and selling investments based on market conditions or other factors. Quantitative investing uses complex mathematical models to identify and select investments. C. Security analysis. Security analysis is the process of evaluating the potential risk and return of an investment. It involves analyzing the financial and operational performance of a company, as well as assessing its industry and market conditions. The goal of security analysis is to identify undervalued or overvalued securities and make informed investment decisions. There are two main approaches to security analysis: fundamental analysis and technical analysis. Fundamental analysis involves analyzing a company's financial statements and other financial data to determine its intrinsic value. Technical analysis involves studying charts and other market data in order to identify patterns and trends that can be used to make investment decisions. International finance. A. Exchange rates and international trade. Exchange rates are the prices of one currency in terms of another currency. They play a critical role in international trade, as they determine the relative value of different currencies and affect the competitiveness of exports and imports. Exchange rates can be determined by market forces, such as supply and demand, or by government intervention, such as currency manipulation. Fluctuations in exchange rates can have a significant impact on international trade, as they can make exports more or less expensive, and can affect the profitability of international investments. International trade refers to the exchange of goods and services between countries. It plays a critical role in the global economy, as it allows countries to specialize in the production of goods and services in which they have a comparative advantage, and to consume a greater variety of goods and services than they could produce on their own. International trade is affected by a variety of factors, including exchange rates, tariffs, and non-tariff barriers, such as regulations and standards. Governments often use trade policies, such as tariffs and subsidies, to influence the level of international trade and to protect domestic industries. B. International financial markets. International financial markets are markets in which financial assets, such as stocks, bonds, and currencies, are bought and sold. They play a critical role in the global economy, as they allow businesses and individuals to raise capital and invest in a variety of assets. International financial markets can be divided into two main categories: developed markets and emerging markets. Developed markets, such as the United States and Europe, are characterized by high levels of regulation and transparency, and tend to be less risky than emerging markets. Emerging markets, such as China. C. Managing international financial risk. Managing international financial risk is the process of identifying, assessing, and mitigating the potential financial risks associated with cross-border transactions and investments. These risks can include currency risk, interest rate risk, political risk, and credit risk. Currency risk is the risk that changes in exchange rates will negatively impact the value of an investment or the profitability of a business. To manage currency risk, investors and businesses can use a variety of tools, such as forward contracts, currency swaps, and currency options. Interest rate risk is the risk that changes in interest rates will negatively impact the value of an investment or the profitability of a business. To manage interest rate risk, investors and businesses can use a variety of tools, such as interest rate swaps and interest rate options. Political risk is the risk that changes in a country's political environment will negatively impact the value of an investment or the profitability of a business. To manage political risk, investors and businesses can use a variety of tools, such as political risk insurance and diversification of investments. Credit risk is the risk that a borrower will default on a loan or bond, leading to financial losses for the lender. To manage credit risk, investors and businesses can use a variety of tools, such as credit default swaps and credit ratings. Ethics in accounting and finance. A. Professional ethical standards. Professional ethical standards are guidelines that outline the behavior expected of individuals and organizations in the accounting and finance industry. They are designed to promote integrity, objectivity, professional competence, confidentiality, and professional behavior. The most widely recognized professional ethical standards in accounting and finance are the Code of Ethics for Professional Accountants, issued by the International Federation of Accountants, IFAC, and the Code of Conduct for Financial Analysts, issued by the Global Association of Risk Professionals for GAAP. These codes of ethics provide guidance on how to handle conflicts of interest, maintain confidentiality, and act with integrity and objectivity in the performance of professional duties. They also provide guidance on how to handle suspected violations of ethical standards and how to report such violations. B. Ethical decision-making in accounting and finance. Ethical decision-making in accounting and finance is the process of evaluating the moral implications of business decisions. It involves identifying and evaluating the potential consequences of a decision for all stakeholders, including shareholders, customers, employees, and society as a whole. In the accounting and finance industry, ethical decision-making is critical because it can have a significant impact on the financial performance and reputation of a company. For example, unethical accounting practices, such as financial fraud, can result in significant financial losses and damage to a company's reputation. There are several frameworks that can be used to help guide ethical decision-making in accounting and finance, such as the utilitarian approach, the deontological approach, and the virtue approach. The utilitarian approach focuses on the greatest good for the greatest number of people. The deontological approach focuses on the moral rules and principles that should be followed regardless of the consequences. The virtue approach focuses on the development of virtuous character traits, such as honesty, integrity, and fairness. In conclusion, ethics in accounting and finance is critical as it affects the reputation, profitability, and the overall performance of a company. Professional ethical standards provide guidelines for expected behavior, and ethical decision-making frameworks can help guide professionals to make the right decision. It's important for the accounting and finance professionals to be aware of the ethical implications of their special topics in accounting and finance. A. Taxation. Taxation is the process of collecting taxes from individuals and businesses in order to fund government programs and services. Taxation is a complex and ever-changing field, and it is critical for accounting and finance professionals to have a thorough understanding of the tax laws and regulations that apply to their clients and businesses. Taxation can take many forms, such as income taxes, sales taxes, and property taxes. Income taxes are taxes on an individual or business's income, and they are typically progressive, meaning that the tax rate increases as income increases. Sales taxes are taxes on the sale of goods and services, and they are typically regressive, meaning that they take a larger percentage of income from low-income individuals than from high-income individuals. Property taxes are taxes on the value of real estate and personal property. Tax planning is an important aspect of accounting and finance, as it helps businesses and individuals to minimize their tax liability and maximize their after-tax income. Tax planning involves identifying tax-saving opportunities and structuring financial transactions in a tax-efficient manner. B. Auditing. Auditing is the process of examining and verifying the accuracy of financial statements and records. Auditing is critical for ensuring the integrity of financial information and for detecting and preventing fraud. There are many different types of audits, including financial statement audits, operational audits, and compliance audits. Financial statement audits are designed to provide assurance that a company's financial statements are accurate and in compliance with accounting standards. Operational audits are designed to evaluate the efficiency and effectiveness of a company's operations. Compliance audits are designed to ensure that a company is in compliance with laws and regulations. Auditing is a regulated profession, and it is governed by professional standards and guidelines. C. Mergers and acquisitions. Mergers and acquisitions, M&A, refer to the process of combining two or more companies into one. This can be done through a merger, where two companies merge to form a new entity, or through an acquisition, where one company buys another company. M&A is a common strategy used by companies to grow their business, increase market share, and gain access to new technologies, products, or markets. M&A is a complex process that requires a thorough understanding of financial, legal, and strategic considerations. The financial aspects of M&A include analyzing the financial performance of the target company, determining the purchase price, and arranging financing. The legal aspects of M&A include reviewing and negotiating the terms of the merger or acquisition agreement, as well as complying with regulatory requirements. The strategic aspects of M&A include identifying the strategic benefits of the merger or acquisition, such as increased market share, access to new technologies, or entry into new markets. M&A can be classified into different types, such as horizontal M&A, where two companies in the same industry merge, or vertical M&A, where a company merges with or acquires a supplier or customer. Another classification is a conglomerate merger, where companies from different industries merge. M&A can have a significant impact on the companies involved as well as on their stakeholders. Complete this assessment and receive a formal certificate of completion from Smart College Online. To obtain your certificate, please send your completed assessment to us smartcollegeonline@gmail.com or on the website smart-college.co.uk. Our team will review and verify your submission, and upon successful completion, we will email you the certificate recognizing your achievement. We look forward to welcoming you to our upcoming series of complimentary courses, which will be held on a weekly basis. Thank you for following us.